how I made my money. So to give you a very short background, I went from like 10,000 euros because I live in the EU, 10,000 euros that I have had saved up to like 500,000 in money and wealth that I have right now, which comes from properties, from investment in the stock market and everything. But all in all, I went from like 10,000 to like 500,000 in a few years, 4 to 5 years. The main growth that came for me, was the properties that I have and I bought in this span of time, but also from the stock market, where I went from like $10 that I had invested, I think 5 to 6 years ago, something like 5 to 6 years ago. I had some money in crypto. Okay, I had more than $10. It wasn't like $10. It was like a few $100s because I was at the beginning of my career as a professional, working in finance in a big four company and then moving around in other companies as well. But at the beginning, I had like a few $100s invested in the stock market, a few $100s in crypto, when crypto was different from right now. And I was able to grow this portfolio to around 100,000, 120,000, depending on the day you're looking at it. And this all happened by using very simple methods. So keep it simple, stupid, I think would be the best way to describe it, because you have like two options for any given person who has no knowledge of finance, no knowledge of anything. You either invest in ETFs, which is the benchmark. You go to S&P ETFs, NASDAQ ETFs, Dow Jones ETFs, other indexes, or specialized ETFs like semiconductors ETFs, like green energy ETFs, like, I don't know, any type of ETF that you want to invest in. Just when you do that, and it's not like a benchmark ETF like S&P, NASDAQ, and so on. So S&P would be for you, like, let's say VOO, or the NASDAQ would be QQQ. When you go to other types of ETFs, just look at the holding of the ETF. So what companies are in the top 10, 20 of the ETF and how much they make. If they make like 25 to 35 of the ETF and they're extremely good companies, you found yourself a promising ETF. Then go over the expense ratio of the ETF and its past performance. Of course, past performance will never give you future performance. It's different, but it's like a minimum that you can do to see how that ETF has performed, how it was managed. From the expense ratio, you will see how much money the fund will keep from you and how much it will affect your profitability going forward. And also the holding is important, because you need to know that the biggest holding, the biggest percentage is in very good companies, and you may have some shining stars there that you can't see right now, and they will, let's say, shine in like a few years. But it's good that the first 25 to 35% of the ETF to be a solid group of companies. Okay, so you have this route, which is like the easiest one, because it's just ETFs. You just invest on a monthly basis, or like every 2 weeks, or even every 2 months, depending on when you have the money available. But it's important to be constant about it. So if you're just investing like $10,000 right now to become a millionaire, never gonna happen. Only if you're like hitting the jackpot. If you're investing 10,000 and like 200-300, 10,000 right now and 200-300 every month, every 2 months, you will at the point make a lot more money, because being constant, sticking to your plan is the most important and difficult part, because people don't have the time. They think they don't have the time, or they don't have the patience, better said, to do that. That's what separates the winners from the losers. So where do you want to be? Winner, loser, winner, loser, winner, of course. So that's a very important thing. And the second one, and what I did, was try to find good companies. I didn't find always good companies. I had some shit companies as well, because it's normal in life. You don't always win. You sometimes also lose. It's important to, one, understand something from what you do wrong, from your losers, and to understand what you did good, because it's also a lesson where you do something good. It's important to understand what you did good, why you chose a certain company that performed well. So take the lessons from what you do wrong, take the lessons from what you do right, add them up, and you're even better and better every time. You don't need to like have 2, 3 5 hours every day investing in learning about companies, reading everything about them. You just have to know some basic things about investing. So like a basic thing would be, from a company you always want revenue growth, profitability, which is also growing, ideally more than the revenue, but at least on par. Why is that important? Well, it doesn't matter if I sell more, if I make and I'm left with less money at one, proportionally speaking. So hypothetically, I sell $100 right now and I'm left with $15 of profit, net profit. If I sell $200 of merchandise, of services, of whatever, and I'm left with $20 of profit, my percentage of a profit is lower than before. So I'm more inefficient. If I'm more inefficient, that's not good. So it's important to either be on par, the revenue growth and the profitability growth to be on par, or ideally better. So you want better control of costs of a company. More than that, you want to have a constant free cash flow. You want that company to be free, to generate a lot of cash, and also to have an economic advantage. You may call it a moat, may call it any other way. You need a bit of an economic advantage. It's either through branding, either through the product you're selling. Let's say a branding example would be Nike. A product you're selling would be ASML. A service you're giving would be TSMC, and so on. So it depends on your position in the market, in your sector. It depends on how well you're positioned compared to your competition. So think of that. Always think of that. Why would I invest in Coca-Cola and not Pepsi? You can look, well, both have very good brands. Then look at what other brands they have bought. Then look at their financials, which is again easy. You have to look at their growth, how they manage expenses, their free cash flow and profitability. And of course, if it's a dividend company, at their dividend growth rate, and sometimes at payout ratios. But normally for good companies, the payout ratio is very, very rarely a problem. You should usually look at their dividend growth. That's where the difference sometimes comes. So this is how I very easily identify very good companies. What PE ratio, DE ratio, 4P, are they helpful? Yes and no, they're deceiving. So PE ratio, in my perspective, is a very deceiving metric. It's okay to sometimes start with it, but don't base your analysis more than like 10% on it. It's a very, very poor argument for investing in a company, because again, it's the picture of a company right now. You're not investing in a company for what it is right now, or not just for what it is right now. You're investing in a company for what it will be. Then you can say, okay, look at the 4P. Yeah, but that's an assumption. We don't like assumptions that much. We want to look a bit, let's say, in detail. 4P is a very it's not a very conclusive metric, in my opinion. So what I've told you earlier, the revenue part, the net profit part, the free cash flow, and also of course debt, depending on how much debt it has. But debt is also a bit dependent on the company. I mean, if you're looking at certain companies, debt is the way they work. I'm thinking of real estate investment trusts. They all have debt, but that's not necessarily a problem, because there you look at other metrics. But again, debt is an important factor, but you have to think it a bit depending on the sector that it is in, on the company itself, and see a bit if you compare the companies that you like, its competitions, how they all look. If they all have high debt or higher debt than you would be used to, maybe that's something normal for that sector or that group of companies. So it shouldn't be a metric that discourages you. Maybe you should look at other metrics that are more important. So if you follow these guidelines, you will find very good companies. You'll find the like top 1% of the companies, but you need to first of all be very constant, be very consistent in your investing strategy. I mean, if you start doing this, you don't stop ever. You have to, if you have more money available, be more aggressive with your investing. I mean, aggressive, not invest in like risky assets. I mean, investing aggressive by investing more and more money, because you can free up some, I don't know, expenses that you've done stupidly in the past. You will not do them again. You're more efficient with your budget and you can invest more. That's what I mean by aggressive. And after that, look at the two options that you have. You either go through to an ETF, either the benchmark or a specialized ETF, or like combine the strategy, or you take this strategy of investing in ETF, either benchmark or specialized ETFs, and also invest in individual companies. You can also go with a strategy of investing, I don't know, like in S&P, and like the 5-7 companies in S&P. Then you will be a bit weighted on the technology portion. But again, it's also a strategy. Try to find a hedging that suits you, because we are not all the same. If I like technology, it doesn't mean that you like technology. Maybe you like another sector where you feel more comfortable. But at least now you know what are the things that you should look at. So revenue, profitability, free cash flow, growth perspectives, dividend growth in case of dividend companies, and if that's of interest to you, and also a competitive advantage, either for branding, products, services that they offer, some sort of a competitive advantage, at least to their competitors. It's ideally, if it's a competitive advantage to an entire sector, let's see how it's for ASML. So that's kind of the gist of it. That's how I chose companies, how I've grown my portfolio from like, again, a few $100s to over 100,000. That's how I've grown my wealth, looking constantly. It applies also to real estate. You don't just pick a house you have to, or an apartment that you want to invest in or buy it. You have to constantly look at them, constantly analyze and everything, because that's how you find the ones that are actually good, cheap, or at least fairly valued. That's all from me. If you like the video, don't forget to like, share, and subscribe to the channel, because it's a new channel. It will help me a lot. Nothing else. It's free if you do that. So why not just do it? And of course, we'll see each other the next time. Bye bye.